I will trade anything that is liquid that I can trade. And therefore, I own Bitcoin at times. I don't own it at other times. Satoshi Nakamoto.
Why the heck would I ever hold, Chinese yuan? In the case of an emergency, they'll just take it away from me with capital control. Right. Good luck. The real thing that the techno-optimists in the AI world are talking about is massive margin expansion. To get to mid-double-digit earnings growth over the next 10 years, you would have to have margins expand by 1% every year for the next 10 years.
If you were a dictator for a day, what would you do? And my answer was I would eliminate the naming of bills, because the Inflation Reduction Act came in when inflation was about 6.5%, with $437 billion of spending behind it.
Welcome to the critically acclaimed Futures Edge, the show that was called Smart and Irreverent, and something about the hosts not being a couple of dumb dagos or something like that. He might not have said the second part, but that was actually said by an important guest. I am Iuorio. That's Bob Iaccino, and I always make the point is that we may be full of shit, but you guys cannot argue that we get outstanding guests, and today is going to be no exception to that. We have Bob Elliot, the CIO of Unlimited Funds, which oddly is what my wife calls the checking account. It's a mischaracterization. Although you've probably heard that one before. That wasn't even original. I'd like to do that one over. How are you, Bob?
That was a total dad joke.
I'm doing good. That one right there it's right up there with people asking me, what about Bob?
I should have thought that movie tortured me when I was a kid.
Well, it was
really when I was a kid. I'm like 106 years old, but they tortured me.
Yeah, I know. You think it was bad for you? I mean, you're at least Bobby.
Hey, were you ever Bobby when you were little or anything?
I was. The tale of shifting from Bobby when I was a little kid. I was Bobby to Bob was when I was doing science nerd camp. In the summer of 7th grade, I decided to my little test tubes were too small to write Bobby, so I then became Bob.
No, that makes good sense.
And then from there on, I was Bob.
Robert.
Never a Robbie, certainly not a Rob.
Where are you coming to us from?
From a secret location, as you can see by the fact that it's totally.
Bob is he's too open and honest on X, so he has to keep his location secret.
That's right. I keep my location.
That's actually probably a good point. Everyone knows my location because I have I own the local restaurant and shit. So if I piss anyone off, they know where to find me. So, but anyway, so just a couple quick formalities: beaches or mountains, dogs or cats, beer or wine.
Beaches.
Okay.
Dogs. Although for most of my life I was a cat person, and we got a dog during COVID, and I love dogs. Great.
Yeah, dogs are fun. Cats you don't get much back from them. Dogs.
I know. She's a bit of a cat-like dog, which I guess makes was a more comfortable transition for me, but. No, she's great. She's a golden retriever and a perfect entry dog into awesome. The world of dog owning.
We're lab people. One downstairs who I only think has a matter of maybe weeks or months left, which is really it's the sad part of dog ownership. But she's all gray in the face and she limps a lot. So that bums me out. She's only 12. I thought she'd be doing good, but I was just talking. But anyway, let's move on from dead dog stories.
That's a depressing start to this.
What the hell? Cut that part out, Haley. Anyway, okay.
I miss beer or wine?
Yeah, beer or wine.
No, definitely beer. I like wine. I can drink $2 wine. I can drink $200. I cannot tell the difference. It means nothing to me.
Yeah.
Beer, though.
I don't like when it's too sweet, but other than that, I'm the same. I can't tell. Like when they earthy tones of raspberry, I don't know what the hell people are talking
No,
about.
it's
So,
not.
I saw one that called it scorch, earth, and pencil lead. Taste of
that's a good
scorch,
thing.
earth, and pencil lead. I'm like, what kind of childhood did this person have?
You better market it. Okay, so for people, in case people, I want to get my first question, and I think Bobby can probably guess what it is because it's a drum I've been beating for about the last year.
Yep.
Since the first auction went poorly, how long ago was that? Like maybe 6 to 8 months ago, right?
Yeah,
So
last summer, right?
Yeah. The first long end auction that went poorly. My base case thesis, which has led me to some good trades, although it hasn't really been right, is that I thought the Treasury was going to tap into the money in the reverse repo, drain it to near zero. They haven't done that. I thought they'd eventually spend all the money from Treasury General to try to boost up the economy before the election. They haven't really done that either. But my thinking was that if they had to move out to the long end and auctions would go poorly, then gold, silver, real estate was the place to be, and that's where I was. It's turned out to be a good trade, even though they haven't zapped all the money in the reverse repo. I think that eventually, if the weight of issuance starts to really weigh on the long end, the Fed comes back in, and I don't know if they start QE again. I think it could be awful for the dollar, and things that Dennis Gartman said hurt when you drop them on your foot could skyrocket. Where are the holes in my thesis there?
Well, I think the basic story that particularly the Treasury side of things would unleash a flood of liquidity into the market, particularly ahead of an election, I think was a reasonable thing to worry about, but not one that ended up working out. And I think in part because the technocrats at the Treasury saw the politicization of the Treasury and said, this is totally unacceptable. We are a executive branch agency, but our debt issuance and our way of approaching things is not intended to be a political activity in order to maintain credibility over the long term. And so I think thankfully the technocrats wrested control away from Yellen in advance of the election, because it could have been, that sort of stuff is banana republic stuff.
Amen.
And so that was a good thing. I think the story about, the overall liquidity in the system, I think we're seeing a basic, that thesis I think is still largely right. And I think that's probably why the things that, you drop on your foot are still doing okay. And it's because, if you just think about it from a monetary policy, from a fiscal policy perspective, we're borrowing a lot of money and continue to borrow a lot of money. And it's hard to see either candidate, or the Congress limiting that in any way in the near future. If anything, it'll likely get worse if economic conditions ever deteriorate. And then on the flip side, from a monetary perspective, look, PCE is still running above the Fed's target. CPI is still running above the Fed's target, and the Fed is making a decision to pivot. And that is not good for the soundness of money and the credibility of money, and it is good for alternatives. And we're starting to see that heat up.
So, Bob, I'm not trying, I don't want to say when I mention this commodity that it's the number one investment right now, but one of my favorites is gold. And I've been long gold since November of 2022. I wrote an article for the CME that they haven't posted yet, where I basically went through 3 or 4 different scenarios, let's say 4. And all 3 of them were gold's going higher. And the one you and Jimmy just described to me still means that to me. Where am I wrong, or where could it go? Because to me, if inflation is going higher, or even if it's stable, and the Fed isn't fighting it, or they're cutting gold, right?
Well, I think gold from a more secular perspective, I find very compelling for 2 reasons. One, from a fundamentals perspective, if you just, what problem do we have globally? Not just the U.S. Gold is a global asset, very important to recognize. So what happens in China and other developed economies and in the emerging world, they all matter to gold supply and demand. The big picture story globally is we have too much debt, and particularly too much government debt, relative to our ability to earn income in the future to pay off those debts. And basically the way that works, and that's a story that has existed many times in the past through many different cycles, and has basically only resulted in one very simple solution, which is the devaluation of money relative to stuff. and income producing assets. And that's how it works out. And so that sort of fundamental, who knows, today, tomorrow, 3 months, who knows? But what matters is sort of strategically, we're in that circumstance that should be beneficial, should be really beneficial to gold over time. And then I think, more structurally, I think gold has benefited from being vastly underowned, particularly in the West. Like if you look at financial advisors, 90% of them don't have literally zero gold in their clients' portfolios. And those that do have gold, the average is like 1% of your portfolio. And you just compare that to stocks or frankly bonds, and you look at it, it's like the whole world is overweight stocks and bonds, and nobody holds any gold. And so it just doesn't take that much shift in allocations. A 1% shift in allocations would be a huge influence on the gold market.
That's amazing.
Can I throw two quick follow-ups?
Sure.
So number one, you said gold is a global asset. We're not really like a Bitcoin show, but we have had crypto people on, like Natalie Brunell, most notably. And I'm always trying to distinguish between the two. I think you said something that's important. Gold is a global asset. Bitcoin is not, right? Not yet. I mean, even like China banned it, at least for a period of time. Could you say that Bitcoin currently is not a global asset?
Well, I think Bitcoin is. There's certain areas of the world that are excluded from it, and excluding China through bans is a pretty big component of it. And you certainly contrast that with gold. Like, part of the reason why there's so much domestic Chinese gold demand from the private sector is because they can't invest in other assets, including Bitcoin, right? So gold, real estate sucks, stocks suck, wealth management products suck. They can't get their money out of the country into dollars. Like, the only thing that's left is to, hold gold. That's it's the long time asset. I think when it comes to Bitcoin, the corollaries, there's certainly some corollaries between Bitcoin and gold. I just think when you think about which people are going to move to in this sort of environment, like gold has a 3,000 year track record in a certain, demonstrating these return properties. Bitcoin has meaningfully less track record. And if you just empirically look at the return pattern, gold is doing what you'd expect it to do given that fundamental dynamic. And the drivers of Bitcoin have been much more idiosyncratic over time. And so, just less confident that Bitcoin is going to be a good alternative currency or a reliable alternative currency.
So just a quick disclosure, Jim and I have both owned gold and Bitcoin for quite some time. I wanted to point that out. And also I want to tell you this is absolutely an endorsement for you people to buy more and push the price of our holdings higher. I'm kidding.
We make no recommendations.
I think actually, gold in particular, I think is fascinating because there's just not that much supply, incremental supply that comes into the market. There's like, there's like a few thousand tons of production a year, which is, meant to meet all of the monetary and jewelry and some industrial demand that comes in. And if you try and get demand that goes anywhere beyond that, you basically have to force people to scrap. And scrapping is like pretty tough. Like, I don't know if you guys remember when gold was spiking, around the financial crisis, like the ads on television that are like, cash for gold, like getting people to like rip like their jewelry and put it into the mail and get cash for gold. That's a very hard thing to get done. And so the elasticity to incremental demand on the gold side is very, very high because that supply just doesn't exist in the market without, price drawing people in.
So I'm going to switch it to the election, but I want a quick follow up to that. Do you own either of those two assets, gold or Bitcoin, or both?
I definitely hold gold in my strategic portfolio. Gold is 10 to 15% of my strategic portfolio.
I thought that was the case. Yeah,
savings portfolio.
So let's move on to the election, and we do not talk about politics at all. We do talk about policy, and when there's a potential of a big election, it has policy implications. Okay, so in my mind, is that if the Harris administration wins, they will continue being a little hard on businesses from a regulatory standpoint, spending pretty freely as they have in the past. Both those things from an inflationary standpoint might balance each other out, and rates may come down a little bit. Donald Trump wins, he's spent like a drunken sailor when he was in office, racked up a bunch of debt. However, I still sometimes argue that he's untested. The deflation was somewhat of a worry at certain points when he opened the checkbook. Not all of it. I mean, I was critical of him spending money, but through a regulatory process, he might be more business friendly, which might make rates stay a bit higher because it's inflationary. What of those scenarios make sense or doesn't?
Well, I think on the Trump side, probably the most important dynamic from a macroeconomic standpoint is actually the tariff implementation and the second and third order consequences of that. The idea of putting a 10% tariff on all imported goods and an up to a 60% tariff on Chinese goods. First of all, let's start by recognizing that's campaign rhetoric. Will that be pursued or not? It is, ambiguous, I would say. But let's say it is pursued. That's the sort of thing that could easily add a few points to CPI, and would cause a relatively substantial effective tax burden that's pretty regressive, and could be demand destroying, in favor of I'd say a questionable number of incremental new jobs that are coming domestically, given that the vast majority of those taxed goods would be things that are basically entirely produced outside the U.S. and, you're not going to get replacements quickly in terms of supply chains. On the Harris side of things, I think you've got a dynamic that is not corporate friendly. And, there's a good long form article in the Wall Street Journal this morning, just going through all the different tax policies. It's very much redistributive from, the rich to the less well off. And it is about, really raising tax rates on corporations. That's particularly challenging for equity investors, because, an increase in the corporate tax rate will translate, relatively directly into equity prices. And so that would probably be pretty bearish for equities, and particularly for low tax equities. And it's also inflationary because the redistribution of wealth, obviously, or income from, high earners to low earners has a much higher propensity for spending, and therefore would likely lead to, higher nominal spending in the economy relative to productive capacity.
I was talking to Tony Nash. I don't know if you know Tony.
Yeah, we've done a podcast or two together. Yeah,
I'm actually supposed to go on with him on Wednesday. He had an interesting. I'm looking for it. I can't find it, but it was an interesting data compilation on tariffs, saying that there really wasn't any sort of transmission in reality to consumers at all, and that the money that came in from those foreign tariffs was actually collected. Now, I don't know if that's accurate or not, although Tony is pretty much a data guy, so I take him at his word, and I can't find the tweet, so I don't understand it. I'm not a fan of tariffs in general. It just goes against what I normally think. We should just have markets, and markets should compete, and may the best country and product win. But I found that to be shocking. Do you find that surprising at all, if in fact it's true that the tariffs didn't really have much of an effect on prices, but did actually bring money into the Treasury?
Well, I think a lot of times folks will look at empirical work looking at inflation right around the implementation of the Trump tariffs. And it's important to recognize that during that period, there was a sharp decline in oil prices, particularly related to a slowing in the Chinese economy and Chinese demand. And so that kind of conflates at a macro picture the inflationary aspects. If you're going to look at this, you got to roll up your sleeves and get real weedy in terms of looking at individual products. So for instance, like one of the most classic case studies is the tariffs on washing machines and dryers. And what you saw there was, the tariffs actually translated to prices that were even higher than the direct tariff on the consumer. And that was as a result of the fact with this washer and dryer thing that the washing machines went up in price, but also the dryers went up in price. Because you probably have, for those of you who bought a washer and dryer, they're basically the same price, right? Same model, same price. And so it had a greater than 100% effect on prices beyond the tariff. So you got to get down into those weeds. I think the case
There's more to it than
not
just the data.
inflationary is thin, both on an intuitive basis and on an empirical basis.
So I found the tweet for anybody who wants to look at it. It's Tony Nash Nerd, and he is a thread from July 23rd that he put out there. So if anybody wants to take a look at it and sort of compare the data, but I get what you're saying. Like in a lot of cases, you take data and you compare it to one result and you say, that's the result. And that's it, as if there was nothing else going on.
Right.
So right now, the story is that both candidates are inflationary, but Trump would be more inflationary. And then we had a podcast last week with Doomberg. I'm sure you're familiar with the green chicken, right?
Of course. I love the green chicken.
He's so great. And he said Trump is really bad for oil stocks. Now, if you look at an equity sector back test, which of course doesn't mean it's going to happen every time, you need to stress that. Oil stocks are one of the best performers in a reflationary environment. So if you have reflation, and then the cause, or one of the causes of that, is a president that's really bad for oil stocks, do you have any idea how that might play out in the economy? Because I don't.
Yeah, I think the challenge, I think, is in terms of the policy translation, certainly at the sector level, I think it's very challenging to understand, given the fact that we don't really, the level of specificity that exists with the policy is, modest. And then you start to get like, how do you then apply it to individual companies and sectors and stuff like that? It is, that's hard. That's a complicated thing. I think it speaks in general to the point where when you're talking about political related activities here, like in general, what you're better off doing is just waiting till the policy gets announced, because there's just, and not just announced, like passed, because in general, people underestimate the second and third order consequences of the policy and don't do the homework to pencil it out and really figure out what the consequences are. And so if, your like ratio on the alpha is pretty bad when the policies are speculative, and actually generally pretty good if you do your homework once the policies have actually been approved. And so you should really just wait till then.
I did have a trading thesis off this that disagreed with Doomberg, because his contention really relied heavily on the correlation between the big integrated oil names and the commodity itself. Well, this is an administration now that was just talking about, denying access to capital markets for fossil fuel companies, regulating the shit out of them to try to keep. So I actually believe in a Trump term, oil should go lower because he's going to be drill, baby, drill, and it's going to be forward looking. But I think the correlation may break down a bit because there is a chance that he removes some of the onerous regulations on some of the fossil fuel companies. And perhaps, and I'm not saying fossil fuel company, I mean, the companies will rally. I'm saying they won't break at the same level that they normally do with the commodity. Am I crazy with that, or is that a reasonable thesis?
Well, I think that the general point that that the administrative state is likely to be reduced under Trump administration is right. And I think that is one of the things that's likely cutting against the inflationary effects of tariffs. But I think the challenge there is just the scope and the magnitude, and essentially, how much are they going to adhere to, and the sort of philosophy behind the most recent Supreme Court ruling related to this. It's just hard to know exactly how far they're going to go, and that's why you got to wait to see.
Thing? Is that what you referred to, Bob? The Chevron doctrine thing? The Chevron doctrine
thing?
Yeah,
the Chevron doctrine. Yep.
That's what I wanted to make sure that's what you're referring to. Sorry. Yeah. Bobby?
Yeah. Just hard to know how far they'll go, right? Because you could easily see a situation where they are incremental, and get headlines, or you could see a situation where, they're trying to loosen regulatory constraints in order to basically offset all the inflationary pressures from the tariffs. It's just, how far will they go? Hard to know.
All right, so let's quit fucking around here. I respect your brain more than you even know, because I've been following you on Twitter for a long time. And I go back and forth. And I think on this first statement, Jimmy will say he agrees. I will trade anything that is liquid that I can trade. And therefore, I own Bitcoin at times. I don't own it at other times. I've accumulated in the past. I'm not accumulating now. I made somewhere in the range of 410% on my accumulated Bitcoin, and thought, well, that's silly. If I made this on Apple or something else, I'd probably lighten up. So I lightened up. And I now trade it. And I'll trade anything. It doesn't have to have intrinsic value for me to trade it, right? And I have a really good friend down here in Southwest Florida, with me. He doesn't live with me, but he lives close. His name is Tim. He's a big fan of the show. And he says he's convinced that Bitcoin is a Ponzi. Now, I don't think it's technically a Ponzi. I think he's just throwing that out there as it's spurious, for lack of a better word. Where do you fall on that? Because I struggle to find Bitcoin's intrinsic value, but I also know that I've owned and traded things that don't have intrinsic value in the past, like trading cards or Nike Jordans.
Paintings, wine. It's the bullshit. It's a bullshit.
I agree. I mean, I agree. At some point, like tulips had intrinsic value or didn't have intrinsic value, and they blew up. So where do you fall on this? And say what you feel comfortable saying, and you can say fuck or shit if you want to. I don't.
If you want to.
Well, I think when it comes to Bitcoin, I actually years and years ago did the first research at Bridgewater about Bitcoin to basically think about whether we should be trading it. And the short story is, I, after looking at it carefully for a while, realized that the primary drivers of it are not related to macroeconomic fundamentals in the way that things like, stocks and bonds and credit and commodities and currencies and stuff like that are driven by macroeconomic fundamentals. And so, basically said, look, I don't really understand the core drivers of this. And, when you're trading macro, you don't have to trade every asset. Like there's no, if you don't have an edge, if you're the most ignorant person at the table in terms of understanding what's going on, you should definitely not trade it, right? Because you probably have negative alpha. And so, I'd say I check in with Bitcoin regularly to see if I can really get to confidence that a meaningful part of the drivers of it are macroeconomic in nature, because that's really my skill set is, macroeconomy, macro markets, things like that. And I haven't gotten to the point where I feel comfortable, feeling like I have edge. There's lots of other people. There are certainly other people who suggest that they do have edge trading it from a macroeconomic or a liquidity perspective. And you know what I say? Good on them. Like it's just it's not my cup of tea. So I don't I'm casually interested, I'd say. But I'm not, I don't trade it. I don't have any exposure to it. Just not something that's in my wheelhouse.
Have you ever seen this?
I don't get it.
Satoshi
Nakamoto. What is the third company though? Nakamichi. I don't know that company.
I don't either, but I just found this very funny, and I was like, come on. It was like, I need to stop sharing this because this is absolutely ridiculous. But I thought, wow, why not? I mean, why not?
Why not?
Yeah.
There is a more than zero chance that Bitcoin is some sort of CIA dark op to, track illegal money going around. People, and again, you can say I'm a crazy conspiracy theorist. I'm not saying that is my base case at all. I think if you think that is impossible, then not you guys, but you're the idiot. You know what I mean? Come on.
If we're going into a room you don't want to follow us into.
Possible. It's
irreverent, smart. What else did he call us, Jimmy?
I can't remember the second part. That's why I put it in the Dirty Dago part.
Hopefully a little crazy. They also said,
he did say that. So nuts.
I like to say unafraid. We've been canceled. What can you do to us now? Yeah. We've been kicked off mainstream media for being, how do we put it? A little too open, let's say.
Yeah.
I have another question that kind of fits in this. You're familiar with Brent Johnson, right? Who's been on a show a couple times from Santiago Capital.
Yep.
And he came up with the dollar milkshake theory, which I thought was a cute name for a really, really interesting thesis. And so if you look at central banks around the world, they used to hold 70% of the reserves in dollars. Now it's closer to 58. They've been accumulating gold at a rate not seen in 75 years. My thesis for trading has always been I believe we have a saying on the show, which everyone has the same saying because Tyson said it. Yeah, everyone's got a plan until they get kicked in the face. I mean, punch in the face. But anyway, so you can say you don't want to rush to the dollar and that you want to keep the dollar at arm's length. But as soon as the shit hits the fan, people tend to run to the dollar. But the thesis is if enough of these BRIC countries and whatever the hell these countries are think they're going to get away from the dollar, then it could put a boost in gold. Back to the theory, though. Do you think it's possible that in our lifetime, and I know I assume you're a bit younger than us, that there could be a spot where we lose the reserve status, et cetera, et cetera?
Well, as a macro person, like, you know, your ability to understand what's going on in the next 6 months is only so good, let alone the next 30 or 40 years. Like,
well, we're not going to hold you for it in 30 years, though, because you know what I mean? You're already going to be retired, so we can't hold you to it, so you might as well take a shot at it.
Yeah, don't make it assumption we're going to be here in 30 years. That's a silly assumption.
If you look at the history of what has brought down core reserve currencies, it typically takes losing a war as a primary reason why there would be a transition.
You just blew my mind, Bob. Honestly, go ahead.
Away from that currency. And so, you know, what are the probabilities? Could I see a situation where there's a meaningful global conflict and the U.S. loses that global conflict, and as a function of that, you know, the U.S. monetary system becomes less important? Certainly, I think to suggest otherwise would be foolish. Absent that, at least, you know, I'd say in the next 10, 20 years, there's not a lot of clear alternatives that exist. And that's really when it comes to a reserve currency. It's not the perfect currency. It's the one that has the deepest, most liquid capital markets with the best sort of legal infrastructure. And that's really, that's the US. Like I always thought, you know, and I was very familiar with some very aggressive Sinophiles, that the idea that China was going to take over, the Chinese yuan was going to be a meaningful reserve currency to challenge the dollar, like that always sounded like garbage to me, given, you know, the infrastructure. I always like, whenever I think about the Chinese yuan and the reserve currency, I think about the comments from the head of the Russian central bank, who's actually like quite a sophisticated thinker in markets. And she's basically like, why the heck would I ever hold, you know, Chinese yuan? In the case of an emergency, they'll just take it away from me with capital controls.
Right.
And I'm like,
good point. Yes.
I'm like, shit, man, if the Russians won't hold your currency as a reserve currency, like, you know, good luck.
And I agree. Do you want them to be the arbiter of global trade? And the answer to that is no. But it's kind of ironic that came out of Russia, considering we did freeze up a lot of their dollars.
Absolutely. Right. But even with that, they won't hold the Chinese yuan.
Still won't trust China. Okay. So yeah, that is an excellent point. And by the way, there's something I want to add and get you to comment on too, is that when what you say, I 100% agree with, is that there is an alternative. You think of the yuan, that's bullshit. You wouldn't want them arbitrating anything, let alone global trade. That the hubris, though, that seeped into the stewardship of our currency, because we know that, has led us down some irresponsible paths. And in some ways, it's a double-edged sword. And this, I mean, again, this may take 20 years, but I could see a situation that gathers steam where these idiots drive it into the dirt. Yeah.
Well, I think probably the most likely outcome is just connecting back to that point we were talking about before, which is like a world that has too much debt relative to nominal income producing capacity will likely see the value of all currencies fall relative to, you know, income producing assets and hard money. Right. And so probably what will happen is that paper currency is going to go down relative to those assets. And whether the dollar is a little bit stronger or a little bit weaker, like, frankly, doesn't really matter. I mean, just look at the last 3 years. Like, the dollar has been stronger than most currencies, but at the same time, it's down against gold, it's down against stocks, it's down against meats, stuff,
eggs, stuff, right?
Right. Yeah. And so who really cares if the dollar is the cleanest dirty shirt when you're thinking about how you're investing?
But the Treasury does seem to care that it's the cleanest dirty shirt because they say show no signs of issuing less debt and spending. Let's talk about Jerome Powell. We heard from him on Friday. He was pretty unambiguous. He said, "Yeah, it's time. We're going to move things." He didn't talk about balance sheet at all, though. To my knowledge, he just talked about pivoting, lowering rates, whatever. If you were the head of and again, our job as asset allocators, traders, is not to say what he should do, is to predict what he's going to do. But if you put your Fed hat on for a second, would you be lowering rates right now or no?
Well, I think if the way I'd answer that question is if I just dropped you into a random economy, right, that you didn't have any context on, and I said, let's take an economy whose growth has been basically at potential for the last 8 quarters, that's seen a modest rise in unemployment, in the unemployment rate, and has seen inflation meaningfully above target and still modestly above target, and interest rates in the same place that they've been for a couple of years now. Like, what would be your action? Okay. And I think the answer to that would be nothing. Like, you wouldn't do anything. You'd be like, it sounds like the rate is about where it needs to be. Yeah, maybe you'd cut a bit on the margin, or if you're a little more inflation sensitive, you'd hike a bit on the margin, but sort of your baseline would be wait and see until something more meaningful crops up. That's obviously not the path that they're going to take, at least initially. I think the main question is, are they committed to a cut cycle to neutral, whatever they think neutral is? Remember, Jerome Powell said that 2.5 was neutral not that long ago. Like, are they sort of committing to that path, or are they committing to saying, look, on the margin, we should modestly cut in response to what's going on? The first seems like total mismanagement in terms of what you'd be doing. The second, I'd say reasonable people could disagree. My inclination would be to do nothing. Maybe you cut once or twice and kind of see how things shake out. That would be fine. Connecting it to markets, though, 8 cuts are priced in over the next 12 months. That is a recession type pace, a depth of a recession type pace of cuts. That seems pretty improbable given the constellation of macroeconomic dynamics going on right now.
Bobby, before I throw to you, just wanted to add that Fed funds market, which has been wrong so long, but I will add that oftentimes there are overzealous risk managers tapping people on the shoulder saying, you have to have this trade on in case. And sometimes that adds a few cuts in that the market's really not predicting. You'll give me that, right?
Absolutely. And the reason market pricing, particularly when you look at things like the short rate curve, are not necessarily, they are just what the market's pricing, right? And then that's what you trade. You just trade what the market's pricing. The market pricing can happen for all sorts of reasons. In fact, like a big reason why why that big structural adjustment happened was, as a result of, like, in response to the deleveraging that happened of positions in response to the VIX spike that have yet to been scaled back up, right? Like, so that, that could be a fundamental or not a fundamental view of things. But when you're trading the markets, you get what's priced in, regardless of what drove it to get to that pricing.
Bobby?
Yeah, I started looking on Twitter because, Jim, you posted up there, what are some questions you guys want us to ask Bob Elliott? And I got into a little loop here about, there's Tony Nash again putting out a story there, or he's commenting on a story somebody put up that China is restricting our access to materials we need to make weapons. So again, it's X. I don't know if any of this stuff is true. Okay, so back to the show. From perspective of whatever you can say, I don't know how limited you are at Unlimited Funds, but what do you like sector-wise going forward, and where do you stand? I think I realize where you stand on recessions now, based on what's going on with the Fed expectations, at least as per the market pricing. So what do you like, assuming the market is partially right? Because I don't think they should cut it all yet, but they are. So what do you guys like there that you're comfortable talking about?
Well, the short answer is nothing. In that sense, like, look, if you look at what's going on with what's priced into stocks right now, you have, essentially 0% probability of recession priced into stocks. And if anything, not just that, but like 0% probability of recession and totally unrealistic boom related to AI over the course of the next decade. So that's what you get in stocks. If you look at bonds, basically you have a totally, 100% probability of recession effectively priced into the interest rate curve, and zero term premium, which is also pretty unrealistic that you'd expect people to continue to, that's a good deal. That's a good deal holding yields given that pricing. And so I look at that picture and I say, neither of these things look any good, right? Assets in general look way too expensive. Stocks and bonds look way too expensive relative to what's out there. If you have to point me in a direction of, going long something, commodities still look interesting, certainly in the pricing, as well as, gold, as we talked about for the reasons that we talked about, look more compelling. But, in general, assets are very bid right now. And a lot of the expectations of a big flood of easing is priced in everywhere. And it's just not clear that that's going to happen.
I got accused of being, I'm sorry, Jimmy, I got accused of being a conservative Fox News shill because I like gold. Because it's all kinds of commercials for gold sellers on Fox News. They're like, oh, we realize now that you're exclusively political because you talk about gold. And so does all these people on Fox News with their commercials. It's like, I don't own a gold company. I don't sell physical gold. I buy it. I don't sell it. Well,
yeah, I think like, I start talking about gold and people are like, grabbing your guns, living in your cabin upstate, like ready to fighting the militia or something like that. And like for people who have studied, if you study gold and you study it as a portfolio investment asset, what you find just very simply empirically is that gold outperforms bonds half the time that stocks are in a drawdown. And everyone holds bonds and no one holds gold. And so if you just look at that, like if you were just an empirically based person and you just said, hey, look, what are the assets that are diversifying to stocks that I can hold? Gold is one of them. And does a pretty good job and does better than bonds in a lot of cases, like we've seen over the course of the last 5 years.
So I want to add something about gold too, because a lot of people think about gold as a non-yielding asset, which is somewhat bullshit. You give me 10 minutes and I hold plenty of gold, physical and paper, and always get a return on that through the options market. As long as implied volatilities are high, you can do that. And as long as you're holding the gold, worried about, burning timbers falling from the ceiling and building your bunker up in the North Woods, then you can have that upside if you give away a little of the front upside. But anyway, Bobby, back to you. I just wanted to throw that in.
Yeah. So from a perspective of the overall markets, when you talk about liking nothing, does that put you firmly in the recession camp? And I almost don't want to ask that question this way, but between the Somme rule and the inverted yield curve and the Fed, that is, Jerome Powell seemed much more dovish than even the market expected. And the stock market, as you mentioned earlier, is acting as if this is good, as if 200 basis points of rate cuts, when anytime you see, I'm not looking at data to back this up, but anytime you see a series of rate cuts like this, I told all our clients and listeners that if it's a policy adjustment, you're fine. If it's a series of rate cuts with the first one or two being aggressive, like 50 basis points, the market will think the Fed knows something we don't know. I maintain we know it already, right? So where do you fall in that camp? And then back to when you said unrealistic expectations for AI. Do you mean productivity? Do you mean earnings, or both?
Yeah. So in answer to the first question, I don't see a lot of indications of why we would be in a recession in the near term, and the incremental data, like the unemployment rate, in part because of some idiosyncratic issues related to it, is like the weakest indicator of what's going on in the economy right now. Broader measures of growth are still running, well above what would exist for a recession. I think the thing that I think is probably the most likely is we get sort of what I call an ugly Goldilocks, which is that, growth is too strong to get all those cuts that are priced in, but too weak to actually meet the elevated earnings expectations that exist in the stock market. And so we kind of like muddle along in a way that's unsatisfying to both stock and bond investors. I think is probably the most likely thing. Turning to the AI story, the greatest techno optimists will talk about how AI is going to deliver double-digit earnings growth over the course of the next 10 years as a function of incremental investment, increased productivity, and margin expansion by companies. And the reality is that just the investment and just the increased productivity, even if you pencil in incredibly good productivity, like a 2% support to productivity, has a very modest impact on earnings because, a lot of that, margins are only 14% or 13%. So, if you get increased productivity and it goes to equally to labor and capital, it's not that big a deal. It helps your top line, but that's about it. The real thing that the techno-optimists in the AI world are talking about is massive margin expansion. And for instance, to get to mid double-digit earnings growth over the next 10 years, you would have to have margins expand by 1% every year for the next 10 years.
And why would they, right? Yeah.
And the challenge with that that the techno-optimists can't answer is if you get more productivity, if you get better margins, what that means is you're firing people relative to your top line. And if you fire the people, who is spending the money? The only way that margins expand is if you have someone else, some other sector to savings. And so in order to get anything close to what those folks are expecting, you'd have to have a different sector of the economy start to save by at a rate that's something like 6 or 7% of GDP every single year forever to support those margins. Are we going to have government budget deficits that are 7% of GDP bigger forever in order to support those margins? Are households going to save 7% of GDP a year? Like, the math doesn't work. And this is exactly the same problem that happened in the tech bubble back in 2000. Is people were penciling out the same sort of outcomes and didn't recognize that the implausibility of having, that productivity boom that isn't met with rising incomes. And that's basically, set expectations that were implausible that then collapsed.
So is that what people are missing in this? That even though we have companies that are profitable, and that's one difference between today and the 2000 bubble, the growth just isn't where the market has priced them in.
Yeah, I think the biggest challenge is whether or not, I think, take a step back, technological innovation is very, very hard to fully understand the magnitude of technological innovation. And the idea, essentially what people are saying is that this is going to have an effect that's equivalent to the personal computer. I'd say, my base case would be that that's probably not true. But, it could possibly happen. But I think the thing that people really miss is the cash flows, because like the laws of physics, cash flows are the constraint to corporate income, right? Corporate income is not it's not a theoretical thing. It's built of cash flows, both in terms of revenue and spending. And if you can't connect, you have to connect that optimism to cash flows to get the outcomes that are being described. And that's the thing that doesn't connect well. And I have talked to plenty of techno optimists, and I've gotten none of them have given me an answer to the question of, if you fire all the people to get those margins, who is going to pay for the top line growth? No one can answer that question.
I think that's brilliant. Now, here comes the time of the show where I'm going to push back on something, because there's something that's bothering me. I want you to reconcile it for me. So you've several times, even though you think the stock market is stretched, which I think that is reasonable as hell, and you think, though, that GDP-wise, we're bumping up against capacity, we're humming along pretty good. Are there moments where you say to yourself, Jesus Christ, we're humming along really good. Why are we accumulating $1 trillion of new debt every 90 days? Expanding M2 over the last 15 months is up, not down. So that, by the way, that can fit into the AI trade. If there's loose liquidity that's still jammed into the system back from 2020, it could be just working its way into different places. But mostly I want you to say, like, it is the government debt and this ridiculous, reckless spending, my words, not yours yet. Is that what's making is it the veneering over what could be a bad economy and a bad labor market, or no?
Well, I think the challenge with government borrowing and the challenge with any debt is that in order to get continued growth, you have to accelerate the debt. And so right. I think part of the challenge was that we shifted from a lower deficit to a higher deficit in order to cushion the effects of COVID. That policy was likely prudent at the time, no doubt, given the deleveraging and disinflationary effects that existed from COVID, and we would have had a pretty bad outcome had it not happened. I think that the challenge and part of the liquidity provision by the central bank through money printing then helped cushion the effect of that high borrowing on asset prices, because they wouldn't have to crowd out other asset prices. That was an important bridge, let's say, from where we were to where we are today. And what happened subsequent to that bridge occurring is that we started to get income growth that has been the primary driver of the expansion over the last, say, 3.5 years. The deficit peaked in mid 2021. I think the challenge is that we sort of kept the deficit as it is. Such a large deficit, because it's stable, hasn't actually improved growth conditions. It's just supported the same level of GDP. And I think the challenge is when we got that sort of growth acceleration that was predominantly income driven, that was an opportunity to sort of scale back the fiscal, right? Yeah. And to sort of ease off the fiscal. It would have been particularly valuable as inflation was too high. Because a little fiscal constraint actually would have been the most effective way to slow inflation quickly. And the problem is that, we basically kept these deficits in place, these recession-like deficits in place at a time when we probably could have scaled it back and put ourselves in a better fiscal position to respond to the next downturn. But instead, we basically ran the economy hot, ran nominal GDP too hot, and haven't really resolved the fiscal problem. So it's not driving the growth, but we haven't taken the opportunity to reduce our reliance on the level of the deficit to support the level of the economy.
So it's a danger, but based on your words, I'm hearing you think it is a mild yet growing danger, whereas I think it's a medium and growing danger.
Yeah, I think what do we mean by danger? Like, I think
a currency crisis. A crisis is always such a hyperbolic word. A currency mess.
Yeah, I think the question is always the big question, as I said, is, we have too much debt relative to our income producing capacity, and we got to reduce the value of money over time. And that'll happen a bunch of different ways. More likely than not, it's not going to be a crisis. And the reason why it's not going to be a crisis is that when you have the debt in your own currency, the Fed can always print money and fund the Treasury if there's, at interest rates that are palatable to the economy. And I think Japan is a good example of how that can play out, which is that, for 30 years, Japan has run very large deficits, printed a lot of money, and, helped contain that. And while the currency has fallen, it hasn't been a crisis. I don't think anyone, if you were on the streets of Tokyo and you didn't really look at, currency or really think about that, you certainly wouldn't say crisis. I mean, inflation was zero essentially for 20, 30 years, right? So it didn't feel like a currency crisis because the debt was denominated in their own currency and the central bank didn't print too much to overinflate the economy. If anything, they printed too little. And so my guess is we'll see something like that, which is that, if the deficits are too large and interest rates start creeping up relative to what is appropriate given the domestic economic conditions, the Fed will come in and print money and help contain the magnitude of those interest rates. The real question is whether they do too much. And that's challenging. Like Japan did too little for a long time. It's certainly easy to do too much in those circumstances. And that's really the risk that you have. So it's not really a crisis. It's more like...
Brings it back to our original conversation regarding gold, right?
Back to gold.
Gold, Jerry. Bobby, do you have anything else, or should we play them out?
Yeah, no, it's funny what you said. I have one more question, but it's funny what you said about fiscal spending and the time. had come to pull it back and they didn't, because
Amen.
I used to ask this question all the time. If you were a dictator for a day, what would you do? And my answer was I would eliminate the naming of bills, because the Inflation Reduction Act came in when inflation was about 6.5%, with $437 billion of spending behind it, which, by the way, talk about productivity. I just asked ChatGPT how much spending was in the Inflation Reduction Act. So there's productivity for you. My question is, somebody else said that everyone under 27 should get punched in the face once. That was another dictator for a day thing. People understood there are consequences thing, and this is how they feel. But that again goes with the conspiracy side of us. So I want to ask you a real question. I think there's an ongoing debate, one led by people looking for clicks and another led by people looking at data. And I'll let you two guys decide which is which. Is there a commercial real estate? Is there a sniff of a problem in commercial real estate?
Can I answer it first, Bob?
Sure.
I thought I've had this in my bag of bad things were going to happen for a year and a half now, and nothing keeps happening. When Mitch Rochelle told us about who actually holds the notes and perhaps the exposure to these mid-level banks wasn't as great as we thought there was. So now I hate to pull back and say, no, I don't think it's going to be a problem, but I'm starting to lean that way. But I want to say that first because I want Bob to tell me how wrong I am.
Intelligent people change their minds when there's new data. So
Bob?
Yeah, I for context, I sort of got my start in the financial markets, figuring out whether or not the financial crisis, the housing crisis, was going to be a big deal or a small deal.
Yes,
I said big deal. I was right, and had some very interesting experiences discussing that with various policymakers ahead of things getting really challenging. And so my experience is drawn on that, and then looking at it today. And what I say is, look, we've totally restructured the U.S. banking system over the course of the last 15 years, basically very explicitly around the idea of not letting an acute credit event emerge again. And I think we're seeing the consequences of that with the fact that, like, big picture, like our shiny office buildings in urban cores way overpriced? Yeah, of course. Do they have too much debt? Absolutely. Are they going to fall in price significantly, and are the debtors going to take a haircut? Probably. But the whole system is somewhere between designed and rigged to make sure that doesn't create a lot of second and third order consequences. And in particular, like, having for the banks a lot of that lending that's on balance sheet means that they have a lot of flexibility to manage through the restructuring of those debts, push them out. Those debts are typically 10, on average between 5 and 10 years. So we got a long time before they actually come due. Even when they come due, you can sit there and you can say, well, you're delinquent, but let me adjust the interest rate, and let me extend the loan, and let me do this and let me do that. I always like to say, the one thing that bankers are good at is not making good loans. They're very good at restructuring bad debts and not taking losses. They're very good at that. The problem in the financial crisis is it was mark to market, and they were forced to recognize loss. Today, they're much more capitalized. They have a lot of flexibility. And let's be honest, the Fed and other regulators are complicit in the desire to make this not a thing. And so there's a reason why almost 2 years into the CRE crisis, the level of charge-offs on CRE is 25 basis points. They're earning 350 basis points of NIM on those loans. So they are making money on those loans because everyone is complicit in making sure that nobody takes any recognition of loss with any pace. And my guess is we'll all be dead by the time that anyone has a conversation about the great losses of the 2023 CRE crisis.
So I will change my answer to that. I think the problems in commercial real estate are largely contained. That's a Fed joke. If anyone doesn't get it, okay?
I love that. That's for our listeners who are actually around during the financial crisis. They will at least appreciate that. I went to a conference recently, and I was like, hey, how many of you were trading through the financial crisis? It was like crickets. And I'm like, oh, God. Am I that old?
Here we go again. Thank you so much for being here. Can you tell the people where to find you, Bob?
Yeah, for sure. If these hot
Not
takes
edit
in
out.
macro were at least somewhat intriguing, you can follow me on Twitter, where you get a steady flow of that at Bobby Unlimited. And I also have a YouTube channel under the same handle. Write stuff about the finance industry over on LinkedIn. So all sorts of content. And if you want to sign up for a newsletter that I write, as well as learn a little bit more about my day job, you can check out unlimitedfunds.com.
And from a neutral observer, I follow Bob on Twitter, and it is an excellent Twitter account.
Yes,
Nuts and bolts, not designed to irritate people like mine is. He's actually trying to inform people. Anyway, thank you guys for joining us on this. By the way, none of this works without the support we get from you guys watching this. Keep up the DMs, the retweets, any involvement you can have on it. We appreciate it. Remember what Bobby and I's mission are, is that we both were castaways from mainstream media for specific reasons that I don't want to get into, but I will get into them. We were always given opinions that were either pressure from producers or pressure from sponsors, and it was a bullshit way to do journalism, whatever the hell you call it is we're doing. But this, by the way, is what we think the future is our opinions might be wrong and they might be bullshit, but they're at least our own honest opinions. And we get great guests like Bob Elliott. This has been The Future's Edge. I'm Jim Iuorio. That's Bob Iaccino. Thank you, guys.